Hello, everyone. Welcome back to another episode of the Weekend Charts. I'm your host, Charlie Bilello, bringing you, as always, the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment, hit that subscribe button for all the latest content. Before we begin, I want to talk about this exciting offer for my firm, Creative Planning. If you go to creativeplanning.com/Charlie, schedule a call or a meeting with an advisor, and you're going to get a free wealth path analysis from us. We're going to take a look at your portfolio, take a look at your plan, making sure you're on the right path for 2025 and beyond. So visit us today, creativeplanning.com/Charlie. We're in all 50 states. We likely have a location right near you, over 345 billion in assets under management and advisement, and we're here to help. Go to creativeplanning.com/Charlie to get your free wealth path analysis. Okay, what's on the docket today? A lot going on. More all-time highs for the S&P 500. I want to discuss the biggest headwind for the U.S. stock market. Fewer economists are expecting a recession, probably not surprising. The hidden cost of housing inflation, I want to talk about that big issue for many of us. The big three are dominating retail. You could probably guess who those three are. I'll run through a chart there. Interesting data points. Big banks, big profits. So the earnings season has kicked off here. Huge profits from all of the big banks. Another record year at Netflix. So just a huge surge in Netflix subscribers, profits, revenues across the board. Big beats for Netflix. And we'll end, as we always do, with something positive: self-driving technology and the improvements that we've seen there. Okay. More all-time highs. Number one, we got to start with the S&P 500. You can see the chart here going back the last 3 years. We had that 2022 bear market. Seems like a distant memory at this point. S&P 500 was down about 28% during that bear market, rallied back to hit an all-time high again about a year ago, and then it went on to have this epic run in 2024 where it hit 57 all-time highs, fifth most of any year in history. And now we're back at all-time highs again, hitting 6,100 for the S&P 500 for the first time. And you can see on this chart here of all-time highs, they're not guaranteed an all-time high every year. There's periods where there's no all-time highs during long bear markets. But in recent years, with the exception of 2023, when we were recovering from that bear market, we've seen at least one all-time high every year since 2013. And what's the question you get regarding all-time highs? Well, oftentimes people are asking, is this a bearish indicator? Do we have any data suggesting the market does worse following all-time highs? Not really. All-time highs by themselves really tell you nothing. They only tend to be followed by more all-time highs on average. If we look at the average returns historically, looking at a year, the S&P 500 on average is up about 10% from all-time highs. These are averages. Now, there's going to be an all-time high at some point in time, like we saw in 2022. That is the last all-time high before you have a bear market. The problem, of course, is nobody knows when that's going to occur. And if you're going to bet on something in the next 10, 20 years, you should be betting that we're likely to see many more all-time highs for the S&P 500, regardless of what happens in the next few months. So it's not just the equity market that is hitting all-time highs. Crypto, if we're looking at Bitcoin, back at all-time highs again here, hitting 109,000 for the first time. A lot of optimism surrounding Bitcoin. Obviously, since the election, you could see it was all the way down at 74,000 back then, hitting a new high on election day, and has just really raised higher. The anticipation, the expectation is we're going to see a lot of bullish things out of the new administration. There was an executive order issued this week saying the U.S. is going to be the leader in crypto around the world. What that exactly means, we don't really have a lot of detail on yet, but a lot of high expectations, I would say, priced into Bitcoin right now at 109,000. And just throw out all of the predictions and expectations of where Bitcoin are going to be in a year. No one has any idea. There's simply too many factors built into this. But I'd say part of this huge rally here seems to be the expectation that the U.S. government in some way or form is going to buy Bitcoin as a reserve type asset. Now, there's been no kind of confirmation of that, but I think part of this rally is the expectation that the U.S. government may do that. If they don't do that, will that be a disappointment? I think certainly, should they do that, that's a big, broader question. I'll likely bring that up at some point in the future, and we can really dig into that. But if we're looking at the financial markets today, you got stocks at all-time highs, junk bonds at all-time highs, you got crypto at all-time highs, home prices at all-time highs. So many things at the beginning here of 2025 trading with a lot of optimism. Okay, let's go to number 2 here. The biggest headwind for stocks. Very important thing for investors to be aware of. First, I want to give you my usual message on politics and your portfolio. Don't mix the two. And you can see here in this chart why you shouldn't mix the two, because most of the time it doesn't matter who's the president. The market tends to go up over 4-year periods. You can see the last 100 years, only been a few exceptions to that. During W. Bush, when we had 2001 recession, 9/11, you had the global financial crisis. And then before that, you got to go back to the Great Depression. You got Hoover and FDR with negative returns. With the exception of that, we've seen positive returns across the board. The last 4 presidential returns, all strongly positive. Obama's first term, 102%. Second term, 66%. Trump's first term, 83%. Biden's term, 65% return. So if you're an investor and you got 30, 40 years or more to invest, you really shouldn't care who the president is today, and you definitely shouldn't be jumping out of the equity market because your preferred president is not in power. If you only invested during Republican presidents, you started with $10,000 in January 1953, only said, I'm only going to invest when a Republican is president, you would have $289,000 today. If you said, I'm only going to invest during Democratic presidencies, $693,000. If you said, I don't care who's president, I'm just betting on America, I'm betting on future prosperity, I'm betting on earnings growth, I'm betting that the future is going to be better regardless of who the president is today, you would have over $20 million. So really no comparison. Don't let politics influence your portfolio. But this is a chart I think that investors should pay attention to because we're in a different place today than we have been at the start of most presidencies, which is to say that U.S. valuations have never been this high at the start of any presidential return. I'm showing you S&P 500 CAPE ratios going back the last 100 years. And at the start of Trump's term here, 37.8 is the CAPE ratio for the S&P 500. Again, valuations never this high. And why this matters, let's not say for the next 4 years, because I think that's too short of a period of time. It could matter in that period of time, but it doesn't necessarily have to. If we look out 10 years from now, when we've seen the highest valuations, we've actually seen the lowest future return. So about 3% on average for the S&P 500 following the highest decile of valuations. And on the flip side, when we had extremely low valuation, so low investor expectations, we've actually seen the S&P have above average performance, about 15% returns on average. Now, keep your expectations in check. I think this is what this chart should be telling you. And it's not just the equity markets, it's the credit markets as well. If we look at high yield credit spreads, and this is simply comparing the yield on junk bonds, so the riskiest segment of the bond market, these are the lowest rated securities. Well, their yield today is only 2.59% higher than the yield on risk-free treasury bonds of a similar duration. And that's the tightest we've seen actually since June 2007. You can see well below the historical average of above 5%. And there's only been a few times in history we've seen credit spreads this tight. So investor optimism in the equity markets, extremely high, in the credit markets, extremely high. And when we've had this high optimism in the credit markets, what we've seen for the S&P 500 is actually well below average returns going forward over the next 5 years. The S&P 500 has done about 3% on average following the tightest 20% of high yield spreads. And we're well in that range today, as we talked about here, 2.59%. Okay, let's talk about economists expecting a recession a few years ago. Many economists were expecting a recession during 2022 when we had that big bear market in the S&P 500 and we had the highest inflation rate since the early 1980s, above 9% for CPI. Today, very different picture, and they're definitely being influenced by the financial markets, I would say, and they're definitely being influenced by recency bias, which is just simply looking at where economic growth was the last 2 quarters. It came in above 3%, and so they're kind of extrapolating that going forward. So very interesting to see this probability really plummet here, lowest in 3 years, so lowest since January 2022. And the Atlanta Fed, which does this estimate of GDP, is essentially saying for Q4, we're going to see another 3% quarter in terms of real economic growth in the US. So expectations from economists are often not on the mark in terms of predicting things. And you could see during recessions where they were just a year before that. Definitely they weren't predicting it before the 2008 recession, definitely weren't predicting it before the 2020 recession. So no reason to say this is predictive of the future whatsoever. It's just another sign of sentiment being more optimistic today than we've seen in quite some time. Okay, let's talk about the housing market, the hidden costs of housing inflation. We've talked about home prices a lot, but I just want to run through the data here. Again, over the last 5 years, 53% increase in national home prices in the US. That's more than double the increase in wages. And so needless to say, this is not sustainable. Historically, the two have been very closely related, as they should be, because home prices should be based on what people can afford based on their incomes. And if their incomes are going up 25%, you shouldn't see the price go up over 50%, but that's exactly what we've seen. And not only have home prices gone up a lot over the last 5 years, which is really the biggest 5-year increase we've seen since the 2000s bubble, so early to mid 2000s. Not only has prices go up, we've also seen the mortgage rate explode higher. So we had a record low in mortgage rates just a few years ago, 2.65% on the 30-year. And where we are today, above 7% for the 30-year. So what that means, it's a double whammy in terms of affordability. So you have a higher payment because the price is higher. You need a higher down payment because that price is higher. And also your monthly payment is going to be much higher because most people are financing the cost of a home. Most people are taking out a mortgage when they're a new home buyer. So what we've seen is really record unaffordability in the housing market, least affordable housing market in history, what I've been talking about. And there's a lot of ways to look at it, but I think this is one of the best ways to look at it, just to say what percent of your income would you need to afford the median priced home for sale. And in 2024, that hit a record of 46.9%, above where we were during the housing bubble in 2006. So is it just prices are going up, mortgage rates are going up? Is that the only thing affecting housing affordability? No, there's other factors as well. And I'd say the hidden cost of housing inflation are that these other areas are now starting to see substantial increases as well. And that would be property taxes, which are often based on the price of a home, and insurance rates. So if your house is more valuable today than it was 5 years ago, a lot more valuable, well, now you're going to be paying a lot more in insurance to insure the cost of that home. And nobody writes you a check, needless to say. When your home price goes up, it's great that home prices are higher, don't get me wrong, but nobody is writing you a check when that home price goes up. But what you do have to write is a check, a bigger check for property taxes, for maintenance, for insurance. All of these other costs are going up. So this is really the hidden cost of housing inflation. The cost to service that asset has gone way up because of general price inflation. And I think this is really starting to add to this unaffordability, because not only do you need to afford that mortgage, which has become extremely unaffordable for most people, but you're not going to get that mortgage if you can't pay for insurance and you can't pay for property taxes, no one's going to give you that mortgage. So definitely seen a bigger factor in these two areas. 32% of the average mortgage payment is going to taxes and insurance. That's up from around 29% a decade ago. And what have we been talking about in terms of the housing market? Really, it's a housing market that's been frozen in time. In 2024, in terms of transactions, these are existing home sales, 4.06 million. That was the lowest we've seen in the US since 1995. So what we have is a situation where it's essentially a stalemate. Supply has come way down and demand is way down because there's no affordability. And so you're seeing this record low in terms of transactions. What would change that? Well, improvement, I'd say, in the affordability picture is the big one that's going to change that. And also just simply more supply. We need so much more supply in the US in terms of single family homes. Hopefully, we see a big boom in building in the year to come to help alleviate that supply shortage. Okay, let's talk about the big three who are dominating retail. Probably guess who they are. We're talking about Costco, Walmart, and Amazon, the big three largest retailers in the US, and their percentage of retail sales over the last decade, just an enormous increase. They were about 11% of all retail sales in 2014, so a decade ago, and they ended 2024. We're talking about a 17% share of retail sales. So huge increase in these three companies and their dominance in terms of retail. And we've talked about in the past, just more and more shoppers shopping on Amazon, Amazon taking share from many smaller retailers. Costco getting that economies of scale, just growing tremendously over the last decade. And Walmart, obviously, the biggest U.S. retailer still, and just getting bigger and bigger. And if we look at the stock prices of these three companies over the last decade compared to the S&P retail ETF, you can see all of them handily outperforming. Amazon at the top there, 1,390% gain. Then you have Costco, 713% gain. Walmart, 292% gain. And then you have the S&P retail ETF at 97%. So next I want to talk about big banks, big profits. Earnings season has begun and we've seen a strong move higher in all of the banks. And that's really been driven by these huge gains in net income. Morgan Stanley, 145% year over year increase. Bank of America, 112%. Goldman, 105%. JP Morgan Chase, biggest bank in the world, 50% year over year increase. Wells Fargo, 47%. Only Citigroup showing a year over year decline in net income. And revenues up with the exception of Wells Fargo. If we look at JP Morgan Chase here, the numbers are pretty incredible. Biggest bank, as I said, in the world. 60% increase over the last 5 years in net income. 58 billion now in annual net income. That's 169% higher than where it was 10 years ago. And definitely we can say that the situation with Silicon Valley Bank going under and First Republic going under definitely has helped the big banks get even bigger and stronger. And look at the share price gains over the last year. You can see huge outperformance versus the S&P 500, which has had a great last year. It's up 25% over the last year. You can see the gains for the big banks, 67% plus for Goldman Sachs and Morgan Stanley. You got Wells Fargo at 64% at the bottom of the list. Bank of America still up 48%. So huge outperformance, kicking off earnings season in a positive way for S&P 500 earnings. Next, let's talk about Netflix here. Another record year of growth for Netflix, hitting new highs in terms of revenue, in terms of profits, 16% year over year revenue growth. So really recovering very strongly from that downturn that it had in 2022. You can see here Netflix revenues all the way up to now 39 billion on an annual basis, and Netflix starting to make some real money, 8.7 billion in terms of net income. Just a few years ago, people said that Netflix is never going to make much of a profit, and a lot has changed. So a decade ago, 5.5 billion in revenue, you had 267 million in net income. and the growth over the last 10 years, 609% for the top line, 3,165% for the bottom line. And what's driving that growth? Well, simply more subscribers paying a higher price. Netflix paid subscribers hit 302 million to end 2024. I think they said this is the last quarter they're actually going to report the subscriber numbers, and they're going to do it maybe periodically after that, but not on a quarterly basis. But just tremendous growth. Biggest year ever for subscriber ads, added over 41 million new subscribers in 2024. I guess the expectations are the growth is going to slow down this year, but nobody predicted 41 million. This is way above all of the analyst estimates. And at the same time they announced these results, they also announced that they're raising prices once again on all three of their plans. Their standard plan going from $15.49 to $17.99, and their cheap ad supported plan going from $6.99 to $7.99, and the premium plan going from $22.99 to $24.99. And across the board, to me, these are pretty big increases. Standard plan 16% increase, the ad plan 14%, the premium plan 9%. So it just shows you that they believe pricing power is there. They believe that these subscribers are going to stick with it. Not only that, they believe they're going to add subscribers with these higher rates. So inflation in terms of this stuff really continuing here. We'll see if there's any pushback in terms of subscribers, but obviously they feel like they can push through these increases and people will stick with the product. If we look at Netflix going back to its IPO in May 2002, it's really been one of the most incredible growth stories we've seen in the US equity market. $10,000 invested at its IPO in May 2002 would now be worth over $8 million if you held it, of course, the whole time. Of course, many people would have been scared out time and time again. Most recently, during that 2022 correction that took the stock down over 75%. So if you had invested, let's say, from May 2002, that $10,000 would have grown to $5.8 million in November 2021. And let's say you held until the low in 2022, that would have shrunk to 1.4 million. And then assuming you held on there, it would have rallied all the way back to 8 million. So this just shows you, of course, the tremendous gains for Netflix over time, but it didn't come without enormous drawdowns and enormous risk along the way. That's true for all of the big winners in the stock market. Okay, I want to end, as we always do, with something positive. That would be self-driving technology. I think there's many positives to this, but here I just want to focus in for a second on the insurance aspect of transportation, which has gone absolutely insanely higher over the last decade. 93% increase in average auto insurance rates. If you're watching this and you have a car and you insure it, you've seen this. Your premium has likely skyrocketed over the past few years. And this is way higher than increase in overall consumer prices, 34% increase. Now, what would help here more than anything else? Well, of course, fewer accident rates. And what might help with fewer accident rates? Well, less human error, less human involvement. If you have machine self-driving technology instead of a human being that's looking at their phone, that's falling asleep, distracted, human error, any number of things, drinking and driving, any number of things causing these accidents, well, a machine over time will likely be able to do it better than a human being. And what we're seeing here, I'm showing you a chart of Waymo, one of the leading self-driving companies. Huge increase in the number of passengers over the past year. From August 2023 to August 2024, went from less than 20,000 rides to nearly 500,000. So this is being rapidly introduced here in California. They're talking about releasing it in other major cities like New York as well. And I suspect once it's proven that it's safe, that it's effective, and that it's more efficient than a human being driving, we're going to see this rapidly spread throughout the United States. And I think ultimately it'll be a very good thing. Think about how much time it will free up for you if you don't have to focus on driving in a long trip. Think about the safety aspect. Think about the cost aspect of insurance rates going down. All of this stuff I think long term is a big positive. So let's end it right there. Thanks everyone for joining me. Have an awesome weekend. If you're watching this on YouTube, hit that subscribe button, and I'll see you next time on the Week in Charts.